How do you choose an investment to go into your pension? It's not easy. There are literally thousands of options. 69% of people surveyed said they feel they lack the skills to put money into a pension. And for me, that's quite an upsetting figure. And I know that when something's hard, we put it off, even though we should do it. That's just human nature, isn't it? I'm a certified financial planner, and I'm here to try and make this easier for you. So let's do it together now. And before we do, just a reminder that what I'm about to show you is just an example. To make clear, I'm not recommending you invest in what I show you, nor with the investment platform we look at. This is what will be appropriate for my level of risk, which is high risk with a long time scale to retirement. If you've not watched the video recently released all about finding a suitable risk level for your pension, watch it after you're done with this one. Okay, so let's look at an example. And what I'm going to do here is I'm going to use my own attitude to risk and how much risk I want to take with my pension fund. And we're going to go and try and find a suitable investment solution. And so we're using AJ Bell for this video. They are just one of many different pension providers out there. And really, it's just one of the more familiar names. So of course, I'm not recommending that you use them, but it's someone that I'm familiar with. And so it's going to be helpful for me to help illustrate this going around the website. Now, what I should make really clear with this is that, of course, this is going to be looking at options that are suitable for my level of risk. In the last video, we talked about risk and what might be a suitable approach for you, depending on a number of different factors. So if you haven't seen that video yet, I suggest you go and watch that after this one, so you've got the context for what we're actually looking at here to help make sure that you can find a suitable level of risk for you and therefore a fund that might suit you or a portfolio that might suit you thereafter. So let's get into it then. So on AJ Bell's website, we want to go to the most obvious place, which would be investing. And then we want to look at the different options. So if we come down to choose your investments, you can see here that there's quite a bewildering array of different options here already. Now, to make it really, really simple, I'm going to say that we're going to jump straight into funds. Now, what funds are simply investments that have a number of different assets within them, trying to spread risk, trying to generate a return, but you're not putting all your eggs in one basket. For example, like you would be if you just had one share that you invested in, like Amazon or Tesla or something like that. So funds are typically what financial planners like myself would recommend to clients that they hold in their pension more often than not. Again, there are exceptions, but typically most people would benefit from holding funds in their portfolio to try and spread risk, try and generate a return. And so, as you can see here, it says that there are over 4,000 investment funds across markets, industries and asset classes. So how on earth do you narrow that down to find something suitable for you? Unfortunately, with terminology and the way that things are laid out, it isn't very easy, but I'm obviously here to try and make that as easy as we can. So broadly, there's two approaches you can go with this. One is that you can choose a pension provider's own portfolios that they've created. And the benefit of doing this is that it really takes choice out of the equation for you. It means that there's typically a suitable portfolio depending on which level of risk that you are, and they will label it as appropriately as such. The other approach is that you go and do a further step of research yourself using, say, some of the filters and some of the drop downs here, which will help narrow down what it is that you might then be able to invest in. But this requires more knowledge or more research done on your part to understand what you're actually clicking and what it's telling you that it's filtering in and out. So let's go with both different approaches here to cater to whether you might want to do the self-select approach or you want to try and narrow something down. And as I said, we use me as an example to look at this. So as you can see here, if you scroll down, AJ Bell say they've got their favourite funds. Now, I would always urge extreme caution with favourite funds and kind of lists where they say here are our favourites or here are our select ones, because what could be suitable for somebody to invest in that is popular might not be suitable for you at all. So please do not follow the crowd when it comes to this. I can already tell just by looking at this list that those top 5, well in fact those top 7 funds, all of them pretty much all invest completely differently to each other. So if you were going to do this, you might just be picking one and having no idea what it's going to do. So please don't do that. Instead, this is a much better approach to take for most people. So they've created a list here of the different types of funds that AJ Bell themselves have created. And what they're trying to do is trying to make your life a bit easier by trying to lay out some of the important bits here. So they're telling you what each of these funds are designed to do. They're also giving the name, which quite often gives very useful clues as to what that fund actually does and what it's trying to do. It's got some sort of independent rating here. So Morningstar are an independent rating agency. And they've also then got a risk and reward spectrum here. So for instance, as you would expect, you can see there's a fund here called the AJ Bell Cautious Fund. Naturally, you would hope that would be lower down the risk spectrum, and it is. If you then come the other end, you can see the Global Growth Fund. That has a much higher risk spectrum. So you can see here there are 10 funds there. Some of those aren't really appropriate anyway because they have different objectives like providing income. And for most people building their pension fund, that's not really what you're looking for. You're typically looking for growth. So for me, where I'm looking to take a higher risk approach, I would look along here and I would see that the Global Growth Fund is likely to be my best bet if I'm looking to find something that matches my higher risk level. So you click into it and it helpfully gives you some information like, is this fund right for me? A bit more about the fund, and what it also tells you here, if you hover over that, this OCF, this is the sort of thing you might want to be looking out for, or an AMC as it's sometimes known. This tells you how much the fund costs. And all things being equal, you want a lower cost fund, unless there is a specific reason you want something that's more expensive, and that is a different topic altogether. But all things being equal, lower costs mean your investments have to work less hard to provide a return than a more expensive fund. So what's in this investment? Well, as you can see, it gives you a little breakdown of the different assets that are in here. And so this says that 98% of this portfolio is in shares. So that is pretty high risk. There isn't much there that's trying to defend against downturns in the stock market. You've only got a couple of percent of cash, and that really is just to allow for liquidity to buy and sell different shares in the portfolio. If you want more information, you can see where those shares are actually split amongst the world. And then if we come into here, we have a chart which shows you past performance. Of course, we have to remember past performance is no guide to the future. It's there to give us a bit of an idea about how the fund behaves, but how it has performed in the past is not a measure of the future. And the reason it's not is because majority of this performance, this growth, is purely dictated by world events. It's not so much the fund itself. And so let's use this tool down here. I mean, this isn't the best charting tool I've ever seen before in my life, but we can work with it. So typically what you want to see is about a 5-year time horizon. That's a pretty good measure of how a portfolio can be expected to behave, because over that time period you've normally had a few drops in the markets, you've normally had a bit of a downturn and some sort of recovery, so this gives you a bit of an idea of how this might behave in different conditions. So if we go back this far, you can see you had the COVID drop. Understandably, this portfolio dropped a fair bit, but if you then look, and here are the Trump tariffs here, you can then see where it is today relative to where it started. And if you look up here, it's grown just a touch under 68% over that time horizon. So roughly 5 years, maybe just a little bit over, you've had 68% return. So that is one option, and it's very straightforward through the website. If you navigate through there to open up a pension and then invest in that fund. Now that would be suitable for me. However, it might not be suitable for you. You have to remember this is all personalised to you. So let's look at the alternative approach, which is if you want to find something a bit more personalised and you want to narrow down this 4,000 funds into something that is much more suitable for you and a much smaller number of options, but you're not actually beholden to the pension provider's own funds. You think that you could find something potentially better from elsewhere in the marketplace. So for me, I know I'm looking for growth rather than income, and growth is sometimes known as accumulation. It's not overly helpful. They've called it one thing there and then you come down here and it's another, but there we go. And so I'm going to be looking at lower cost funds because, as I said, that's typically what you want to be looking for. I would broadly invest in market tracking investments, but that doesn't mean that's right for you. That's just the way that I would prefer to do it. And so when we come here, we want to be looking at equities, known as stocks and shares, for a higher risk approach. And so what they've also got are their different risk ratings. So let's look at those top couple. And so you then go and we can see that we've already filtered that over 4,000 down to 187. So we're getting somewhere quite quick. Now, what I would like to do is I would actually like to sort by charges. And so I want the lowest possible charges at the top because, again, that really does have a bearing, along with the asset allocation, on the growth and the performance of that fund. So let's have a look at some of the funds that we can now see that have popped up through the filtering and through the sorting of the lowest to the highest fund charges. So we can have a look and we can see that there's one which talks about Japan. So it's likely to be some Japanese stocks and shares based in there. We can also see here the Europe 600 stocks. I know that is the 600 largest companies based in Europe by market capitalization. You can see an MSCI World, and that relates to global stocks and shares. Now, let's come to one that might be familiar, particularly if you keep an eye on finance and are interested in the topic. This is one that gets talked about all the time, and we're just going to use it as an example, the S&P 500. So we can see that Fidelity provide a portfolio that tracks the index, which, as a reminder, is the 500 largest companies in the US by market capitalization. Let's go and look at a bit more about it. So we can see that the charge for it is 0.11%, which would be on top of whatever AJ Bell, in this case, charges as a pension provider for managing the pension. And we can find out a bit more about the objective of the fund, which basically describes what I've just said there. And we can also look at what would happen if we'd have put £10,000 in 5 years ago. As you can see here, if we'd have had the foresight to put £10,000 into this fund, it would have grown to just under £20,000, £19,694, almost doubling the contribution from 5 years ago. So that, you can see in this particular instance, would have been a pretty good return for putting that money into your pension. But of course, past performance is no guide to the future. You'll be fed up with me saying that by now, but it is true. We've had good market conditions for growth over those 5 years, so that might not be repeated again in the future. So this is just one of the potential options for me, because that would match my risk level. It might not be appropriate for you. If you wanted then to find something else that was more appropriate for you, this is where you would need to try and play around with some of these filters, particularly the ones where it talks about risk rating. And so really, in my mind now, I've got a choice between buying the S&P 500, which is the obviously American 500 stocks, at 0.09%. That would broadly be appropriate for my personal risk level. Or I could go and buy the AJ Bell Global Growth Portfolio at 0.31%, and that is invested slightly differently. That's up to AJ Bell how they want to invest it, and they will potentially change that over time, but it shouldn't deviate a huge amount from how it's supposed to be set up now, but it may do. Whereas this, you have an understanding of exactly how that's going to work if you understand the S&P 500, and you are just participating in the growth of the American global stock market.
So what next? Well, watch the recently released video all about risk, and check out the Notion to-do list in the description below, also providing a summary of this video. After that, download the free Business Owner's Guide to Financial Independence that we've created using the link in the description below.